Good morning, hunters, and welcome to the Daily Hunt for Multibaggers. It's Saturday, May 23rd, 2026, and we're digging into the market commentary and AI-generated insights from yesterday, May 22nd.
That's right, Ethan. Our AI has flagged quite a mix today. We saw a fair number of discussions across social media with a wide range of stocks getting attention. Overall, the sentiment out there is really fascinating. A blend of high optimism, especially in emerging tech sectors, but also some significant caution, particularly around current valuations.
Definitely a dynamic market, full of opportunities if you know where to look. Let's dive into some of these individual names, shall we?
Absolutely. Kicking us off, we have Rigetti Computing, RGTI. Our AI picked up on user posts indicating a recent strong bullish movement and excitement, particularly around government funding in the quantum sector. It seems like many are asking if they should FOMO back in after a big run.
Exactly, Brooke. There's genuine buzz, about Rigetti receiving that $100 million in U.S. government backing as part of a larger $2 billion investment in quantum computing. That's a massive catalyst, signaling strong institutional support for a truly futuristic industry. It could really accelerate their path to commercialization, which is super promising.
Well, Ethan, while that funding is certainly a positive headline, our KPIs are flashing some serious yellow. RGTI is currently unprofitable with an EPS of negative 0.89 and a net profit margin of 0. And that price-to-book ratio at over 15, that suggests enormous future growth is already baked into the current share price. Plus, we're seeing net insider selling, which can be a cautionary signal. Previously, RGTI has often been flagged as a stay away or speculative gamble in our commentary, and these core financial risks haven't fundamentally changed yet.
So, despite the exciting quantum news, the numbers are telling us to proceed with caution.
Precisely. For RGTI, our AI-generated insight suggests a stay away.
Moving on, AST SpaceMobile, ASTS, is next. This one consistently generates a lot of buzz. Users are talking about 500 to 1,000% runs and saying the upside is just crazy. There's huge anticipation for their satellite launches, and new leveraged ETFs are even launching specifically for ASTS, which tells you something about the market's conviction in the space sector.
It really does, Ethan, but the KPIs for ASTS are frankly quite concerning. It's deeply unprofitable with an EPS of negative 1.8 and negative operating margins. The debt-to-equity ratio is over 112%, indicating significant leverage, and the price-to-book ratio is north of 15. What's even more striking is the substantial insider selling, over 18% of total insider shares sold in the last 6 months. That's a serious red flag, suggesting those closest to the company might not share the same to-the-moon sentiment. This has consistently been flagged as a stay-away in our past analysis.
That insider selling is a tough pill to swallow, I'll give you that.
So for ASTS, the AI-generated insight is a definitive stay-away.
All right, let's look at Redwire Corporation, RDW. One user was pretty happy with their options gains and believes it probably has some room left to run. They've had some significant contract wins, like NATO and U.S. Army drone contracts, which is a big deal. Plus, the overall buzz around a potential SpaceX IPO is certainly a tailwind for space-related stocks like RDW.
Ethan, the short-term gains are great, but for long-term investors, the picture is still challenging. RDW is unprofitable with a net profit margin of negative 0.809 and an EPS of negative 2.59. It also carries a high debt-to-equity ratio, and we've observed significant insider selling. While the news about contracts is positive, it hasn't translated into fundamental profitability yet. It's been a stay-away in our previous commentary.
So more caution for RDW then.
Indeed. For RDW, our market commentary suggests a stay away.
Next is Intuitive Machines, LUNR. This company is generating a lot of excitement, being called a potential 500 to 1,000% runner in the space sector. They have an impressive revenue growth rate of nearly 200%, and even Deutsche Bank upgraded their price target with a buy rating. That's institutional validation, Brooke.
It is, Ethan, and the revenue growth is certainly eye-catching. However, the profitability metrics are deeply concerning. LUNR is unprofitable with an EPS of negative 0.87. More critically, its price-to-book ratio is negative 18.29, which indicates negative shareholders' equity due to accumulated losses. That's a severe fundamental weakness. While they had a buy rating on May 12th, these underlying financial realities, particularly the negative book value, warrant a downgrade from that position for any new entry.
That negative book value does sound like a significant hurdle.
It is. So for LUNR, the AI-generated insight is a stay away.
All right, let's turn to a big one, Alphabet, Google. Now, after some past regret for underestimating its growth, users are noting its robust revenue growth of almost 22% and an excellent net profit margin of nearly 38%. Google is pouring massive investments into AI infrastructure, showing strong strategic vision, and we're seeing significant insider buying, which is always a great sign in a growth story. This has been a consistent buy for us.
Ethan, if it's true that Google's financial health with that strong revenue growth, net profit margin, and return on equity looks compelling, the insider buying further reinforces confidence. While one analysis flagged it for a stay away because it was removed from value stock status by Russell, the underlying business strength and strategic AI moves clearly support a positive outlook now. This has been a solid performer for a reason.
Right, the shift from value to growth isn't a bad thing when the growth is this strong.
So for Google, our market commentary suggests a buy.
All right, let's talk about Debangi, QBTS. This one's been really hot, with some users seeing it as a potential 500 to 1,000% runner in the quantum computing space. The big news here is the $100 million CHIPS Act funding. That's a huge catalyst, leading to massive stock surges, and there's definitely community optimism despite previous stay-away ratings.
Ethan, that funding is certainly a lifeline, and it's driving a lot of speculative interest. However, if we look at the fundamentals, QBTS currently has negative revenue growth, it's unprofitable with an EPS of negative 1.14, and has a high debt-to-equity ratio. The price-to-book ratio is also quite elevated, indicating future potential is already priced in. While the CHIPS Act funding could eventually improve these KPIs, it's a bet on future execution, not current financial strength. This still sits squarely in high-risk territory.
It sounds like a high-stakes play for sure.
For QBTS, our AI-generated insight is a speculative gamble.
How about IonQ, IonQ? Another one in the exciting quantum space. Users are eyeing it for a potential 500 to 1,000% runner in quantum computing announcements, and massive quantum announcements, and a diversified strategy. We're even seeing some insider buying here, which I always like to see in a growth story. The long-term potential of quantum computing is undeniable, Ethan, but IonQ also comes with significant risk. It has an extremely high price-to-earnings ratio of over 163, a very high beta of over 3, and relatively modest revenue growth compared to that PE. Its operating margin is still negative. This suggests a heavy reliance on future unproven success to justify its current valuation. While the insider buying is a good signal, the financial reality remains a major challenge.
So, another one for the brave, right?
Exactly. For IonQ, our market commentary classifies it as a speculative gamble.
Last up is Advanced Micro Devices, AMD. This one has been a powerhouse. Users are recognizing its strong past growth, and the company is making massive AI investments, like a $10 billion commitment in Taiwan. CEO Lisa Su is even projecting 35% annual CPU market growth. Plus, consistent insider buying shows confidence from the top. It has been a buy for us recently.
Ethan, AMD's strategic moves in AI are incredibly compelling, and the insider buying is a strong positive. However, the stock is trading with a very high price-to-earnings ratio of over 156, and it's near its 52-week high. It also carries a high debt-to-equity ratio. While the long-term growth prospects are strong, especially with their AI initiatives, the current valuation means there's less margin for error. Entering at these levels demands caution, despite the positive outlook. It's been a mixed bag of ratings recently, but the core strength is there.
Sounds like a solid company, but perhaps pick your entry point carefully.
Precisely. For AMD, our AI-generated insight is a cautious buy.
All right, to wrap things up for today, let's run through our AI-generated list for further consideration. Investigate as buy, Alphabet Inc., GOOG. Investigate as cautious buy, Advanced Micro Devices Inc., AMD. Investigate as speculative gamble, DQBTS, IonQ, IonQ.
That's all the time we have for today's Daily Hunt.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for tuning in, and happy hunting.